Now, for a little bit more analysis in terms of the performance of our market, the outstanding performance today, we're joined by Julia Lee from Bell Direct. And Julia, what did you make of it?
Well, given it's been so long that since we've had a decent win on the Australian share market, I'm going to take this one, James, up by 1.3% today. The only thing that concerns me is the lack of volume that's come, and really volume acts like an accelerator pedal when the market's going up and really the decelerator pedal when it's going down. So when you see an up day with not a lot of volume going through the market, about $4 billion being traded on the ASX, then you know there's not a huge amount of confidence in the move, although it has been a very positive one. Across the market, mostly a sea of green. The defensive area is underperforming, which is what you'd expect when the market is rising strongly. The standout sector on the market today was by far the financial space. Every single stock in the financial sector traded up today. The worst performers, which gained less than 1%, were just AMP and ASX. All the others in the index managed to gain more than 1%, and the gains were led by AMP and QBE. So altogether, besides Lendlease and ASX, which traded less than 1% higher, all the rest in the financial space doing very well. Also, the material sector making a huge gain in the second half of the trading session. We have seen futures on the Chinese market up by a massive 3%, in fact reaching a 3-month high, and that's done wonders for the iron ore stocks. We've seen Fortescue up by about 6.4%. The energy space is worth a mention. LNG, they're up by 6.4% on no announcement being made to the market. So altogether, it was very much risk on. The only thing that's a little bit concerning is the lack of volume coming through on the market.
We're likely to go?
Look, there are a few warning signals coming through. The lack of volumes was one that I mentioned. The disconnect between the bond and the equity market is another. And often bond traders, when they look at the equity market, think that we're a little bit slower to react. So the bond market could be sending a warning signal to the equity market. And that's certainly one thing that I'm keeping an eye on. But if you have a look at the bond market, it's been in a massive bull run from 1982. So it's essentially a 33-year bull run that we've seen in bond prices. So to see a little bit of a reversal in terms of that 33-year context, it's actually quite a small move in comparison to history. There is also a disconnect in terms of what's going to happen to interest rates in the US. Although the Federal Reserve has been very clear that it wants to raise interest rates this year, a lot of traders are a bit skeptical whether the US economy could handle it. And there's a bit of skepticism that perhaps the US Federal Reserve is just talking its way into an interest rate rise rather than there being any solid action behind it. So a bit of divergence in terms of views around interest rates in the US, the bond market and the equity market, a bit of a disconnect there, and also the volumes coming through in this run-up that we've seen on the equity market rise, a little bit of a concern as well. So there are a few niggling doubts there and a few warning signals. On the other hand, when you do see the yields on the banks at around about 5.6 to 6%, and if you have a look at the franking credits, well, that rises to more than 7%. These yields look quite attractive in an interest rate environment which is at record lows here in Australia at 2%. So that's another consideration as well.
Right, Julia, very much for that. Julia, we don't have long, unfortunately, but we had a couple of interesting data points out today, both the unemployment read as well as some China data later in the session. What, if any, impact did they have for markets?
Well, I think the China numbers were a bit of a relief later on in the day. The numbers coming out at around about 3:30, so in the run-up to the close to the market, and most of the numbers on expectations. Industrial production, retail sales on expectations, and fixed asset investment slightly below expectations. So I think a bit of sigh of relief there, given that we have gotten used to a trend where some of those China numbers have been weaker than expected. The employment numbers are better than expected. The unemployment rate down at 6%. In fact, WA, where the mining boom is supposed to be coming off, seeing a big drop off from 5.6 to 5%. So I think a grain of salt taken with those numbers, but a massive reaction in terms of the Aussie dollar. If I can bring up the Aussie dollar and how it traded today, very volatile ride, but you can see the employment numbers saw a massive surge in terms of the Aussie dollar. Just before our market opened, though, at 7 a.m, we saw a big drop off because of that New Zealand rate card, and probably expectations that we may see more of the same here in Australia, but those employment numbers really helping to support the Aussie dollar today.
Great stuff.